This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages. Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
And today, we're going to take a look at a new tax in Europe that could actually level the playing field in manufacturing.
Plus, how clean energy may not necessarily mean green energy.
But first, it is one of the biggest deals in the software sector ever. Broadcom buying VMware for $61 billion, a 44% premium in that record tech deal. We're going to get a lot of detail on this from the micro to the macro. So let's start broad here with Anurag Rana, Bloomberg Intelligence senior software analyst. Anurag, if I was to take away one thing from this deal, whether it be price, valuation, what would it be?
For me, it's the importance of software. At the end of the day,
you are a software analyst, so
I'll tell you, 10 years ago, and in fact, Paul is the one who gave me the software coverage. I think software was about $300 billion in total, spending. Now it's over 700. And I won't be surprised that in the next 6-7 years, it is going to easily be over $1 trillion. Just because this is exactly where bulk of the spending is going from all enterprises.
Anurag, it's, smart guys like you on the Bloomberg Intelligence technology team like Mandeep Singh and Woo Jin Ho, you guys have been talking about the cloud for a long time here. And this is a deal about the cloud here. Is cloud still the growth story in tech?
Yes, Paul, it is the growth story. It is going to be the growth story for another decade. We just published a massive report that shows that cloud is only about 21% of total tech spending, despite being around for over 20 years. And the reason for that is there's still a lot of legacy footprint of legacy technologies from all the older companies that have been in existence, and they need to upgrade.
So do they upgrade and outsource it, or do they take the time and money and upgrade it and do it in-house? Like, where are we learning how that shakes out?
So I think it's a bit of a both. So if it is a non-critical workload, it's okay for you to send it to an Amazon or a Microsoft or a Google. If it's a critical workload, you may have to redesign your internal IT departments or internal IT infrastructure. Over there, you're still going to be using a bit of technology from the hyperscale or the large cloud providers, but then you're going to use cloud or software products from the likes of Red Hat or VMware or even Microsoft to upgrade your internal system.
Anurag, just broadly defined, it seems like your industry, the technology industry, wasn't really, that impacted by this past 2 years of this pandemic. I mean, the tech spend cycles are so long and they're so, I guess, in demand. It's kind of like table stakes for so many industries. You have to spend a lot on tech. Mm-hmm. Is that kind of what you saw in terms of overall spending levels?
Yeah, it was. And we expect that trend to continue. I think this is the biggest difference in what we are seeing right now compared to the previous cycles, because what used to happen was in the old recession days, the answer was, well, we're going into a recession, so let's start cutting tech spending a little bit so that we can, curtail some cost. Now, don't take me wrong. A little bit of that is still going to happen in the next recession or in the next 12 to 24 months. But we think that's going to impact more of the legacy products. That's going to have an impact on some of the hardware spending or hardware upgrades. But areas such as security and cloud, you're not going to see a massive pullback.
Does this mean that this industry isn't as cyclical as it once was?
Well, in totality, the tech space could be, which means we will still see the ups and downs in the semiconductor world, in the hardware world, or even in the consulting practices of some of these companies. But when it comes to areas like cloud, as I said, if something was growing 20%, maybe it grows only 15 to 16, but we're still going to see very good growth.
Hey, Anurag, I'm going to put my banker hat on here. And as I looked at this Broadcom-VMware deal, a big deal, so I was calculating the fees that my banker friends were going to get. But I also recognize that maybe one of the reasons Broadcom stepped up here is it was a relative bargain, relative to where it was even at year end. Do you think we're going to see more M&A maybe driven by price in the tech space?
Yeah, we also recently published another note that says, we have seen a massive decline in valuations over the past 6 months. But our discussion is, please don't expect any bargains, because we have seen certain deals that have happened just in the cloud space, and they have gone out at a very, very healthy multiple. There were a couple of deals by private equity, such as Thomas Bravo took Anaplan private at a forward, sales multiple of about 13 times. We looked at about top 60 companies. They are now trading at a forward multiple of about 6 times. So,
wow.
We still think there's going to be deal activity, but please don't expect any bargain.
Who are some of the acquirers? Like, who really needs to beef up this area for themselves?
So when we looked at all the large companies, a few names that came to our mind were IBM, Adobe, Salesforce, SAP, Workday, and ServiceNow. So those are the ones that we think could be the ones buyers. Now, Microsoft and Oracle would also be in those lists, but they already have 2 very large deals pending, Activision by Microsoft and Cerner by Oracle. And then the other 2 companies that have the capacity to buy stuff in the software world are Amazon and Google, but we are excluding them for our wish list or our list of potential acquirers because there's a lot of regulatory pressure on those 2 companies.
Yeah, and they got other problems right now, to be sure. Hey, Anurag, thanks a lot. We really appreciate it. Anurag Rana, Bloomberg Intelligence, senior software analyst.
Coming up on the program, we're going to dig deeper on that big tech deal, Broadcom-VMware.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Big deal in the tech space. Broadcom buying VMware for $61 billion in a record tech deal. Certainly an active week in tech. Let's bring in our senior tech analyst, Woo Jin Ho. He covers all things hardware for Bloomberg Intelligence. So, Woo, a big deal here. Give us a sense of maybe what Broadcom, tell us what Broadcom kind of does and kind of what they're trying to morph into with this acquisition.
Sure. Thanks for having me on, Paul. So Broadcom is one of these leading analog chip makers. They make chips for networking gear. They make chips for the Apple iPhone. They make chips for cable modems, right? And in the past, it's a very cyclical industry. Mm-hmm. So what the CEO has embarked upon back in 2018 is a diversification strategy. They acquired a company called CA, and then if you fast forward a year, they acquired Symantec, a security company, and then today they decided to further diversify the business. So software becomes 50% of total sales with this $61 billion VMware acquisition.
So VMware is a cloud company. Was Broadcom in the cloud at all?
So VMware makes software that helps enable companies bridge their way to the cloud. And one of the chips that Broadcom makes, they're actually the leading chip provider for networking gear for companies like Amazon Web Services, Microsoft Azure Cloud, as well as Google, right? So they are the de facto standard for the cloud. So, this is actually a really good question, Alex, because they're able to take a lot of their chip DNA and probably take a lot of the knowledge from VMware and merge it together over the long term.
So, this is a big premium to, just a few weeks ago before Bloomberg News had initially reported on this deal earlier. Give us a sense of valuation. Is this a case where maybe Broadcom said, boy, the NASDAQ's pulled back more than 20%. A lot of these stocks are cheaper. I'm going to just kind of sneak in there and see if I can grab this thing, because they did pay a big premium.
Yeah. On Friday's close, it's a 45% premium. But if we think about it from other typical deal valuations, and we looked at it fairly closely, I don't think Broadcom overpaid for the deal. From a PE basis, it's at 20 times forward earnings. On an enterprise value to sales basis, it's about 5 times forward sales. Now, we comped it to other large cap mature software companies that are cash generating. And the average was actually spot on. So quite frankly, if anything, I think Broadcom paid a fairly fair price. It's just that the market has slid so much, and I think this was when they thought it was time to strike.
I can imagine that other cloud software makers are going to look at this deal and be a little nervous. There is a go shop period. Do we expect other bidders to come in? And if not, who are going to be the competitors after Broadcom swallows up VMware?
There are a couple of names that are floating around who may be interested, and I'm not 100% convinced that there will be another acquirer. But the one company that I did flag was Cisco Systems. Cisco has been trying to go on this a similar diversification strategy from their hardware business to morph into more of a software business.
Two big companies here, $60 billion acquisition. Give us a sense, Wooj, of kind of maybe regulatory hurdles here. Is there anything that could put a monkey wrench into this deal?
Well, so they're setting a timeline of 1 year to get the deal closed. They mentioned on the call there wasn't anything that was really flagged on the call that would ring alarm bells. I did speak with our regulatory analyst colleague Jen Rhee, and there wasn't anything that really stood out. I'm sure there might be some overlap. But if there are any overlaps, they're probably going to be small.
Okay, so let's pretend like it goes through. What are going to be the big competitors? Like, whose lunch will the combined company be stealing?
Well, the big competitor here, and I don't know if they'll be entirely stealing, but the big competitor here will probably be someone like IBM Red Hat, and also open source cloud software. But IBM Red Hat would probably be the one company that goes head to head in terms of the enterprise / open source / cloud software. Now, there are a lot of other small software companies that are out there that VMware competes with. Now that being said, however, the major concern from the VMware customers is that Broadcom may shed so much of its R&D that they may be uncompetitive in the future over the long term, because Broadcom is not putting in the necessary development dollars to drive new innovations. So, if Broadcom's going to milk it for cash flow, then it may just wither over the long term and allow some of these smaller guys to fill a void that VMware exited out. So we'll have to see how it plays out over the next 5 to 10 years.
Hey, Wooj, Bloomberg News also reported this week alongside the announcement of this deal that Broadcom's going to come to market $32 billion of debt commitments. The banks have already committed to it. How does the balance sheet for Broadcom look kind of pro forma here? Are you concerned about that at all? Yeah,
so my associate and I actually ran the balance sheet analysis here. They actually have a fairly healthy balance sheet. They've been bringing it down quite nicely prior to the deal. On a forward EV to EBITDA basis right now, on a net debt to EBITDA basis, it's about 1.4 times. Post deal, it's probably going to be about 2.5, 2.6 times leverage ratio. And they're going to still be able to keep their investment grade rating here. Now, if we think about it from a cash flow perspective, they're going to be generating roughly about $25 billion post deal, and that's going to still allow them to do a couple of things. One, bring down their debt at a fairly aggressive fashion. Two, maintain their dividend. Three, they also announced a $10 billion share repurchasing program. So if that's not a confidence in the cash flow going forward, I don't know what is.
All right, that's good stuff as always. Woo Jin Ho, Bloomberg Intelligence Senior Technology Analyst.
All right, coming up on the program, we're going to take a look at a new tax in Europe that could level the playing field in manufacturing.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele. It is 25 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We're here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide.
As earnings keep on coming out, the big question becomes which companies are getting hit by supply side issues and which companies are getting hit by demand destruction issues. Now, some of the agricultural equipment companies are kind of right in the middle of that. They have their own supply chain issue, and also farmers are getting really hurt on their margins, so it's hard for them to go buy and spend a lot of money on big ag equipment. So let's get the view from that and sort of what do we expect over the next 6 to 12 months with Chris Ciolino, Bloomberg Intelligence industrial analyst. Chris, good to chat with you. Where are the guys like Deere and Caterpillar in the middle of the demand cycle?
There's certainly no demand destruction out there. I think one of the resounding themes that we heard from earnings season was that there has been no slowdown in demand. The demand backdrop is still intact. This is a supply-constrained market and probably will be for the balance of the year. Backlogs are at record levels. Orders remain robust. So there really is no signs of demand slowing whatsoever. It's now a function of can the supply chain keep up, and will the end user still continue to take these price increases?
So, Chris, give us a sense of the supply chain. What are some of the big areas where, the Caterpillars and the Deeres of the world are really having some problems?
It's everywhere. Earlier in the year, we saw semiconductors being the big constraint. That seems to have improved slightly here in the beginning of this year. But now we're hearing it's everything else. It's wire harnesses, it's pumps, it's very broad-based, and it's in no one particular geographic area. And remember, you need all the components to make a truck or a tractor, so it doesn't take much to hold up production. What we're seeing is a lot of these companies will run the equipment through the line and move it off to the side, just waiting for those final components, and then they have to run it back through to once the final components arrive. So the factory overhead absorption is terrible right now, which is part of the issue that you're seeing on the margin line, along with the higher input and material costs.
I know you said demand was super strong, but farmers are running out of a lot of things. Like, their margins are getting really squeezed. Yes, I know the ag prices are high, but their input costs are so high. Do we expect demand destruction from the farmers at any point?
We started to see farmer sentiment soften earlier this year, particularly after the Russia invasion of Ukraine, and fertilizers being kind of right in the center of that. It seems to have stabilized right now. At the end of the day, if crop prices are high, farmers are going to be making money, and typically they do spend on equipment. So long as we're in this elevated commodity price environment, which we anticipate to persist for at least the next couple of years, just given the supply-demand dynamics, particularly coming out of the Russia and Ukraine. We also have some weather issues in North and South America. We had a late spring here as well. So the backdrop for the farmer and crop prices still continues to be unbelievably strong. Yes, input costs are going up, but some of these new, more technologically advanced machines can help offset some of those higher input costs. They're more fuel efficient. They use less fertilizer. They're more productive. So there are some offsets there.
One of the things we're hearing, I guess, in the automobile manufacturing industry is they're not going to go back to the days where they made 17, 18 million cars and then lots were flooded with cars and you go in and haggle for a deal. Is that a similar type scenario in the equipment business? If I'm a farmer and I kind of go onto the lot in Iowa and am I going to have my pick of 10 or 15 or 20 tractors and then I can kind of haggle for a deal?
I think those days are gone. I think very similar to the auto space. Inventories are, if not at record lows, near record lows. And I think a lot of companies would prefer to run with the leaner inventories. It helps one from a pricing perspective. But yeah, I think we're looking at a longer term, a more leaner dealer channel. And listen, they want more equipment on their lots because the demand is strong now and they can sell it. But I don't think we're going back to prior days of having lots filled with equipment.
Yeah, it's like a whole different cyclical journey then with these guys. Okay, so then I guess going forward, how quickly are these companies saying that the supply issues that they have everywhere will be resolved? Like you mentioned, the semis have already felt a little bit of relief.
Yeah, the expectation at the start of the year was it should progressively or gradually improve as the year progresses, and I think those expectations have been totally walked back this quarter. I think universally across the machinery sector, the expectation is that supply challenges will persist for the balance of this year at least. If you look at some of the implied guidance for the back half of the year, no one's really anticipating this big top line acceleration. So I think expectations of any meaningful improvement are kind of out the window at this point.
Hey, Chris, thanks so much. Great to catch up with you. Chris Ciolino, Bloomberg Intelligence industrial analyst.
All right, coming up on the program, a new carbon tax may cost importers billions in the European Union.
Oh, goody. Okay, you're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Hey everybody, thanks so much for joining us. One of the biggest issues globally is inflation, and nowhere do you see that in a more prominent way than the inflation that we're seeing in Europe. Now, it could actually get maybe a little worse, and that's because we're dealing with a carbon border adjustment tax. Let's get more on this with Bloomberg Intelligence analyst Clelia Imperiali. Clelia, the carbon border adjustment tax, first of all, what is it?
So indeed, this is a very fascinating initiative in the trade and taxation area because the CBAM, which stands for EU Carbon Adjustment Mechanism, would be the very first transnational carbon tax ever adopted by any country of the world. And its aim is really to complement the EU domestic carbon tax scheme and to close one of the major shortcomings of the system, which is that domestic producers currently face a somehow unfair competition from products imported from outside the bloc, because while EU domestic producers face increasing prices under the EU ETS scheme, they often compete with imported products that are not subject to any carbon cost at all in their countries of origin. This has been a major problem for the EU ETS and has prompted, can continue triggering in the future, what is called carbon leakage. That is the dynamic to relocate outside the Union in an attempt really to bypass the EU carbon costs. So what the CBAM wants to do is to close this loophole and to put a price on the emissions that are embedded in the European imports. So in a way, to match the carbon price that would have been paid if those products imported in the EU had been produced within the Union.
What countries within the European Union perhaps are more at risk or more exposure to this type of tax?
To answer to this question, we really have to look at the which are the major partners, so exporters to the EU. And for the sectors covered by the initial proposal by the European Commission, which is not being adopted yet, we can see that Russia and China would be among the most prominently affected countries. And for Russia in particular, accounts for a larger share of products like fertilizers. 30% of the fertilizers imported by the Union come from Russia. And similar percentage, 17%, are held by China when it comes to aluminum and steel. So this would be initially the countries that would be mostly affected. But I want to remind here that the initial proposal will cover a very limited number of commodities. And this list, which are aluminum, iron and steel, fertilizers, and cement. But this list is meant to expand in the future and cover also indirect emissions, because the initial proposal will cover only direct ones, as the system comes fully in place after 2026.
Well, how much is this going to cost companies? And I started off the segment talking about inflation. If it's going to cost companies billions of euros to deal with this, it's not like you can just go and find an aluminum mine somewhere in the middle of Europe. So I wonder how inflationary this is going to be. What kind of numbers are you guys running?
Yeah, so the variable really to calculate the potential cost is really the emissions embedded in the tons of CO2 emitted in the production of these goods. And of course, this is not an easy number to estimate because most countries actually don't have to, and companies in many countries are not under obligation to report those numbers. So what we use in our model is we try to use the carbon intensities of the largest companies in the countries that account for more than 5% of export to the EU, and then we've calculated the cost in three potential carbon price scenario, EU ETS carbon price scenarios of 50, 75, and 100 euros per ton. And according to our calculations for the sectors so far considered, which I mentioned before, we're talking about a minimum of over 2 billion euros per year to a maximum of over 4 billion per year. Now, one thing I want to say here is that this is a tax which, most trade measures, will be like a tariff, will be paid by importers. So the companies are actually, while this indirectly affects the exports from the countries that we mentioned before, the companies that will actually pay the price will be EU and mostly energy, construction, and agri-food companies that are the main users of the emission-intensive materials that are targeted by the mechanism so far.
Good distinction. It'd be interesting to see how this plays out. Clelia, thank you very much. Clelia Imperiali, Bloomberg Intelligence industrial analyst. All right, now let's turn our attention to the employment picture in Europe. We kind of dabbled in inflation. Let's get the read on jobs. And for that, we're going to take a look at earnings from Randstad. Randstad is headquartered in the Netherlands and provides temporary employment services. Eshan Toorabally covers the company for Bloomberg Intelligence. Eshan, what did we learn from earnings from Randstad?
Well, so Randstad is the largest staffing company globally, and they had a pretty good quarter compared to their sort of immediate peers. I think they had organic revenue growth of about 15%, which outpaced Adecco, which is the number 2 globally. So it's really a quarter where they continued the strong trend they've been seeing previously, but it's quite an interesting time given that there's a lot of uncertainty globally from an economic perspective. So while the first quarter was pretty strong for Randstad and the group, and there are question marks for the outlook.
So talk to us just about staffing in Europe here. I mean, in the States, I don't think anybody's coming back to the office here. I mean, the train into the city on the weekends is packed. Everybody's going to restaurants and bars and games, but during the week,
Monday morning, forget it.
Morning, it's me and a couple of crickets. So talk to us about staffing in Europe. How is it trending there?
So I think it'll maybe be quite similar. So we're all coming back from the pandemic sort of slowly, I guess. But what's interesting from an employment point of view or from a staffing company point of view is that it doesn't really matter where we work as long as we're working. And I think one of the key things that's going on at the moment is that the employment data, whether it's in the US or whether it's in Europe and the UK, for example, is actually quite strong. So unemployment is at 50-year lows in the UK and is not far off that in the US. I think 20 basis points less of an unemployment rate and you'll be at 1969 lows. So the data is good. People maybe have changed their way of working, but are still working. It's just maybe working more from home, as you say, than in the office as we kind of rebalance after the pandemic. But yeah, that is a similar trend, I would say, in Europe.
So what companies or what regions, maybe, depending on which you think has the stronger data, are really hiring right now? And where do you see any pauses?
So I would tell you, so this is the intriguing thing about the first quarter set of results, which I wrote about. Essentially, all regions are recovering pretty well. The US is probably the strongest sort of large market in terms of employment growth currently. The UK is also very strong, and this is sort of a recovery after the pandemic. Europe has been a bit more patchy because there were some sort of more onerous restrictions in the first part of the year in places like France, as the Omicron variant was sort of, led to some lockdown restrictions and so on. But we're kind of moving through that at the moment and coming out of that. So I would say on a broad level, employment is doing well. But the question mark is, given what's happening globally with, the Ukraine situation, with inflation going up, will there be a recession later in the year? And that's kind of what the share prices or stock prices are telling us, but not necessarily the first quarter earnings or the data so far.
Eshan, post-Brexit, is London still the cool, fun, desired place to go for young people? The UK in general, London in particular, as it's always been for pan-Europe and other parts of the world?
I would say it's probably maybe too early to sort of conclude definitively what will be, the final verdict on that. What I would say, and also we've obviously had the pandemic for 2 years, so that's kind of, taken over all of the trends and so on and so forth. Given the strength of the UK sort of employment data, the sort of the economic recovery we're seeing, since the pandemic, there's no real sign that London has necessarily suffered, from Brexit per se. But I think that trend will only really reveal itself in the longer term. But up to now, there's no real discernible, effect on London particularly.
Let's talk about it from the company perspective. In terms of staffing companies, like which one is doing the best, which one's making the most money, kind of staffing everybody else?
So there's two groups of staffing companies. There's the large global players, and there's sort of slightly smaller, more niche players. So within the larger group, Randstad, as we talked about, is the one that's doing the best. Grew by 15%. It's a pure play on staffing, so it doesn't have other parts to its business. And its immediate peers, which are Adecco and Manpower Group, are currently digesting acquisitions, which Randstad isn't doing. So it's kind of benefiting from a pure focus on staffing. From the smaller sort of niche group, I would say Robert Half in the US has been doing fantastically well and has seen significant top-line growth of in excess of 30% in the first quarter. So that would be the one I would say is benefiting. So the smaller names tend to grow faster than the larger names at the moment, and within the smaller group, Robert Half is probably seems the most resilient.
All right, Eshan, thanks so much. We really appreciate it. Eshan Toorabally, Bloomberg Intelligence Senior Commercial Services Analyst.
And that's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.